Welcome to Let's Buy a House, the podcast. I'm your host, Miriam Gilmore, and I am so excited that you decided to join us on this podcast journey. Here we'll talk all things about buying a house, but more importantly, how to get there. Your credit, down payment, how to save money, all the things. I want to be a resource for you. Here we go. Welcome, friends. Today we are talking about none other than the bank statement program. I wanted to make this podcast talking about the bank statement program because there are so many self-employed and small businesses out there that I feel oftentimes, they get the short end of the stick because they're just trying to make ends meet. They have to file tax returns in a certain way, which is according to our tax codes. The way that we file tax returns, we are allowed to write a lot of expenses out of our businesses. But all of that stuff that we do, that we write off expenses, which are totally, completely legal, and that is why we have the tax codes that we do. But on the other side, when you're going to buy a house and you're a business owner, it works against you because the tax returns don't support you buying and qualifying for a home. So I wanted to make this video. It's not a video. I wanted to make this podcast because I wanted to talk to you, the small business owner, and the self-employed person, and let you know that there are programs available just for you, designed especially for you to be able to buy a home. And one of those programs is called the bank statement program. I happen to really be fond of it because I see how it's helping people with small businesses be able to buy a home and get their families in a house and start their generational wealth building. Because at the end of the day, my belief is that through real estate is how we build wealth. So let's get into it. The bank statement program is basically a program that allows for an underwriter to review your bank statements, and it typically can be a 12-month period or a 24-month period. And basically what they do is they look at the bank statements, let's just use a 12-month, for 12 months, and they average your deposits into your business bank statement or your personal, by the way. Wherever you deposit the most amount of money, that's the bank statements that I would suggest you use. So in this case, let's just use that you're putting it into your business. They look at the deposits and they average it. So for all intents and purposes, let's just use that you average $20,000 in deposits. Typically what will happen is they'll say, okay, well, your expense ratio for your business, we're going to use 50%. And so they'll use $10,000 of your $20,000 average deposit as your income. If you're someone who maybe says, hey, I don't have a 50% expense ratio. I don't really have that many expenses in my business. I have a lot more profit. They will allow you to provide a letter from your CPA or your accountant stating what your expense ratio is. Oftentimes, it might be 20 or 30%, and as long as you get a letter from your accountant and it's verifiable, then they will be able to use that adjusted expense ratio and increase your income to be used by the amount of the expense ratio. So that's a good thing, right? At this point now, you're able to use that number as your monthly income. Now, I want to point out there's certain things that sometimes are like a little bit of a red flag, and you want to make sure when you are looking at the deposits that you don't have a lot of that. So sometimes I have borrowers who have like one random large deposit, and typically if that's not like a regular occurrence, they will remove that from the deposits and not include it. So unless there's a viable reason that you can give an explanation and that it can be shown that it's maybe twice a year, every year you get that, and we can show that, then perhaps it can be used, but that's up to the discretion of the underwriter if they will use like a one-time super large deposit that doesn't really trend with the rest of your deposits. So that's something that I've encountered, and I just want to put it out there because that's something that you might want to like review all your bank statements and make sure that what that looks like. And I'll let you know, typically when somebody submits bank statements to me, it's not me who's taking those deposits and making those calculations. I usually will send this to my lender of choice, and then they will go ahead and give me the number. They send it back in like an Excel spreadsheet, and they say, this is the income that we're going to use. Then I go back to you, we discuss it, we review it, and voila, we have an income amount that is not based off of your tax reports or your tax filings. And by the way, we don't even use tax returns for these loans. We only use your bank statements as income. Obviously, we're still going to look at your credit score. This type of loan is going to be a little bit different in terms of like, it's not going to be like a Fannie Mae loan where you can just put 5% down. That's not the deal here. Here you're looking at 20% down. So you do have to have a little bit of a down payment, significant. I want to say that I've seen maybe even like 15% down. But the smaller the down payment, there's a hit on the rate for that. So just keep that in mind. If you're not wanting to put a large deposit, unfortunately, that can affect your interest rate. And these programs, the rates are really, really competitive, I believe. You know, I always say to people, listen, you're going to pay for it somewhere. So if you're not paying for it in your tax return, you're going to pay it in your mortgage, because you got to pay somewhere, right? It's just the name of the game. So I think that this is a really good option for somebody who's self-employed, small business. And I've seen a lot more people being able to come into home ownership with this program. People that would have had to sit back and maybe file, and by the way, file 2 consecutive, because you know that they require 2 years consecutive of trending income on tax returns. So they would have had to wait 2 years. And you know how much appreciation happens in 2 years. So if you buy a property today, 2 years from now, I mean, if you look at the trend from a couple years back, I mean, people were like, you know, in 2 years, doubling the value of the house. So now you're not having to wait. There's a viable option, and this I think is a great one. So yeah, I hope that this was helpful and that you can consider possibly that this might be something for you. You don't have to sit on the sidelines anymore. There are so many options. And I'm talking about the bank statement program, but there's also other programs for self-employed people that is not, and I'll make other podcasts about it. There's also the profit and loss statement, which is really cool, and it's not based on bank statements. Which other one? Let me think. Oh, and then there's a 1099. So yeah, there's a lot of options for people nowadays, and you don't have to sit on the sidelines just because your tax returns don't look that great. I hope this was helpful. As always, if you ever have any questions, any concerns, please feel free to reach out. I'm super reachable, and I love to help anybody that I can with these types of questions, programs, and buying your house. I want to thank you for joining me on this episode of Let's Buy a House, the podcast. It's always my joy and honor to have you as a listener. And I would love nothing more that if you found value and you enjoyed this podcast, that you'll share it with your friends. Maybe leave a review. It's always such a nice thing to hear from you guys. I'd love nothing more than to connect with you guys on other platforms like Instagram, Facebook, and my personal favorite, TikTok. I'll see you next time on Let's Buy a House, the podcast.